Principles of finance, a la shmup. Simplified lemonade stand. All right, people, time to simplify, and yeah, Thoreau still has nothing on us. All right, well, let's go back to our little lemonade stand and drill into some of the more difficult elements of the income statement. All right, the income statement right here, this thing. Yeah, read through it. Are you skimming, reading? Are you paying attention? All right, good. Okay, so let's think about when our big question here is easy. When are revenues revenues? All right, that's also from Jeopardy. Well, when a customer stands at your stand and pays you the dollar for their lemonade and they drink it and they say, "Boy, howdy, that was good," and they walk away, well, that constitutes a clean sale. We're going to assume that 30 minutes later they aren't throwing up from food poisoning and then coming back to, sue you. And even if they did, well, the cost of defending yourself wouldn't be a revenue item on the income statement. It'd be in a new category you just realized you need, legal and insurance or something like that. So a clean sale makes for clean revenues. Well, when are they dirty? Well, revenues are dirty when a sale may or may not happen. That is, there isn't certainty of revenues. But when is there really certainty? Well, you could posit that when cash goes into your Bank of America coffers, that's a sale. But what if there's a 3-month money-back guarantee attached to it? Don't you have to reserve some amount of money for the number of people who will exercise their right to that money-back guarantee? Well, how do you do that? Well, in the beginning, you really have no history, so you essentially make all revenues deferred. And yep, that's a new category. And as soon as the 90 days are up, then you can call them revenues. But over time, if you have 1% of your revenues pretty steadily being redeemed for the money-back guarantee, well, then you can start to reserve way less than the 100% you started with. And it's rational that in a given month, if you took in $1 million, that you reserve $10,000 for that kind of guarantee. Well, why would you have started with 100% reserves? One word, gap. Yeah, we whispered it. All right, we'll say it out loud. Gap! Yeah, not the Levi's store, people. The religion of gap tells you that you must do the most rationally conservative thing that you can do when accounting for money. And since you were just starting a business, you had no idea if the product was going to end up being a defective clunker or something really good where 1% or less was ever redeemed. Okay? So that's deferred revenues. All right, what about the credit card issue here? Well, we noted earlier that credit card companies take a fair chunk out of your purchases. In this made-up example of nothingness, let's say the credit card companies take 3% of sales. Well, on $1 million, you pay them $30,000 and you keep $970,000. All right, well, do you book revenues as $1 million or as $970,000? Answer, $1 million. Why? Well, this isn't the most conservative, so why wouldn't you claim revenues at just $970,000 instead of goosing them up to be $1 million? Well, because credit cards are a very common way of doing business. In theory, everyone in your industry uses them, and it's fair to assume that a very large part of, say, a bicycle shop's revenues will be paid via credit card. When standard practice dictates a certain set of costs that are common to an industry, you adopt the most common methods of accounting in that industry. All right, now here's another twist. What if revenues are suspect or iffy or uncertain of being paid? Imagine you're providing lemonade to the Super Bowl. Well, if there's a risk that you won't in fact be paid for your million cups of lemonade, from those deadbeats at the NFL, should you still book the $1 million promised to you as revenues? No, of course not. You do still suffer the expenses of having had to produce and deliver the lemonade, however, and you are still liable if people get sick from it, even if you never get paid by the NFL people. Well, maybe think about that when you negotiate your contract, i.e. that they pay you X% up front so that if they renege on the deal, you've at least collected enough cash up front to cover your cups and a little bit more. Well, the hard part here is figuring out what to deduct for risk of non-payment. Is the NFL going bankrupt anytime soon? Well, not bloody likely. Do they have a history of not paying their vendor bills? No. Will they claim non-performance on your part, i.e. that you didn't actually deliver the 1 million cups of lemonade? Also, not likely. They had a lot of that on camera even. Well, do they have a history of subcharging you? That is, claiming that the cups you brought left a mess on the floor and now they had to clean up the sticky mess and deal with the ants. So instead of paying you the $1 million you thought they would, now they're going to deduct 50 grand for cleanup and just pay you $950K. All right, well, all these factors play into how you calculate revenues. No hard and fast numbers are embedded here. You just need to demonstrate that you thought about this rationally. Why would someone want to state revenues as being really low and the regulators not be okay with that? Because you're being super conservative here, right? Well, revenues being stated as overly conservatively low have a big effect on one particular line item on the income statement, all else being held equal. Want to guess which one? Rhymes with schmaxes. Yeah, if you had expenses of 400 grand and revenues of $1 million, well, you'd have pre-tax profits of 600 grand and pay your 30% tax, or whatever the number is in your state and country and so on, of $180,000, 30% on 600, yeah, that's how we got there, to net 420 grand in earnings. But if you somehow came up with a rental guarantee on the lemonade, with the notion being that, well, nobody really buys lemonade, they rent it, right? And then you were somehow able to defer those revenues to be recognized some years later, well, then maybe you can show only 500 grand of revenues instead of that $1 million this year. You still have the 400,000 bucks in expenses. Nothing else changed here, not even sales commissions to your reps. So you'd show just 100 grand in profits, pay your 30% tax, and you'll have paid 30 grand in taxes instead of 180 grand you paid before. Key idea here, you still collected the full $1 million in revenues. It's just sitting in your bank account. You're just not recognizing it yet as clean revenues. Yes, it's accounting chicanery, book cooking, and other falsities when you go to these fake extents to be conservative. And if you do find yourself being encouraged by your CEO or whoever to do your accounting like this, either consult Glassdoor.com fast or think about whether or not your body looks good in stripes. Yeah, they're slimming.